The conventional wisdom is that no one ever went broke taking a profit. Is that really true?
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Let's say you have two stocks in your portfolio. Both of them you paid $100 per share. One of them is now at $400 a share, and the other one is at $50. Should you take profits and reinvest into the losing position, or let your winners keep winning? In this video, I'm going to show you the historical evidence to suggest when you should take profits in stocks. We'll look at a study that calculated the returns of 8,000 different stocks in the Russell 3000 index from 1983 to 2006. That study shows us what winning stocks, those that returned over 1,480%, all had in common. Then I'm going to show you the surprising evidence for why looking at the 52-week high list might be better than looking at the 52-week low list for your next stock idea. And then we'll look at two investment legends, what they say about taking profits. And then at the very end of the video, I'll give you 3 reasons why you should take profits in stocks. The other day, I was reading some investment research reports, which is apparently a sick and twisted thing that I like to do, and I came across one of the most interesting studies I've ever seen. It's called the Capitalism Distribution, and it was published in 2004 by Crittenden and Wilcox. And what these two researchers did was look at the Russell 3000 index from 1983 to 2006. So those 3,000 stocks each year, there actually ended up being about 8,000 in total over this time period. And they wanted to know how the returns of the individual positions impacted the returns of the index itself. And what they found was that the Russell 3000 returned about 10% per year, which comes out to about 880% over that 23-year period. However, the average stock that made up the Russell 3000 returned negative 1.06%. So the average stock that made up the Russell 3000 had a negative return, even though the index itself produced 10%. That makes no sense. How is that even possible? Well, it's possible for 2 reasons. The first is that the Russell 3000 is a market cap weighted index. So as a stock increases in price, it also increases in weighting in the portfolio. So in a sense, the Russell 3000 never sells its stocks. So winning stocks make up a larger and larger position, while losing stocks make up a lower and lower weighting. This is relevant because of something called the asymmetry of returns. So if you looked at a chart of all the returns of the 8,000 stocks in the Russell 3000, you would see something like this. So we'll say this represents the number of stocks, and this is the return on the left axis. So the study tells us that 50% of the stocks returned a negative 1%, which means that all the stocks on the left, these worst performers, probably look something like this. So there's a very small amount of stocks that end up going to 0, and then there's a bunch of stocks right here that basically just do nothing or go down somewhere between 0 and 75%. On the other side, we see that the best performing stocks did something like this. So the very best performing stock might be something like Netflix or Apple or Amazon, and those might have returned something like 10,000% or some ridiculously high number. So the asymmetry of returns is simply that the most you can lose in a stock is minus 100%, but the most you can gain in a stock is essentially unlimited. So if you had a portfolio of 50 stocks and half of those stocks would go to 0 and the other half would be on this side of the return spectrum, the overall portfolio would do sensationally well. Even though half of the stocks went to 0, the other half did so well that they made up for it and then some. And when we look at the study, we see the same type of phenomenon. So the index goes up 880%. However, 75% of the 8,000 stocks, if you add up all of their returns, it was 0%. So the vast majority of stocks added nothing to the index return over a 23-year period. 18.5 of those 8,000 stocks lost 75% or more of their value and never recovered. 316 of those stocks lagged by over 500 or more percent. In effect, they went to zero, or pretty close to it. On the flip side, we see that 25% of the stocks are responsible for the entire 880% gain. There were 1,493 stocks that went up by 300% or more, and 500 stocks, or roughly 6.1% of the 8,000, went on to beat the index by over 500% or more. So if the index went up 880 and these stocks went up at least 500% more than that, these stocks would go up 1,380% or more. So what exactly does this mean? If you're managing a stock portfolio, you have, say, 50 companies in there, what does this study have to do with you? Let's say that you have a hypothetical 50 stock portfolio and you never touch it for the next 23 years. What could you expect that portfolio to look like? We'll say each of those stocks you put $1,000 in. Well, if we have the same return distribution as this study, we could calculate that 2 of your stocks will be worth about $0. 9 of the stocks will be worth $185 or less, so you lost 75% or more of those value. 9 of the stocks would be worth $185 or less, and then 14 of the stocks would be a negative return, ending up somewhere between $185 and $1,000. 13 of the stocks would go somewhere between flat and be worth $4,000. You'd have 9 stocks worth $4,000 or more, and then you'd have 3 extreme winners that would be worth $15,000 or so, or potentially more. You might have 1 stock worth $50,000. So with this information, we can get 3 takeaways from this. The first takeaway is that you should probably let your winners win. In the example, we had 11 stocks that would go from a price, if you bought them all at 100, they'd go from $100 down to $18.50 or lower. You'd have 12 stocks that would go from $100 to between $400 and $1,480 per share. So if you had 2 stocks, one you paid $100 for it went to $50. The other stock you paid $100 for it went to $200. Which of these is most likely to be in the losing category, and which is most likely to be in the winning category? Well, we can't know for sure, but it is most likely that the stock that's down is going to fall into this long-term losers bucket, and it's most likely that the stock that is up is going to fall into this long-term winning bucket. So by selling stock B and reinvesting it into stock A, you could be making a very smart value decision, but most likely you're taking money away from the most dynamic business and putting it into a business that likely has long-term concerns. Some of the greatest investors of all time have also agreed with this mentality. Warren Buffett says the advice, "You never grow broke taking a profit," is foolish. And Peter Lynch, who ran the Fidelity Magellan Fund, absolutely crushed the S&P. He says that selling your winners and holding your losers is like cutting the flowers and watering the weeds. So the lesson from these 2 investors is clear. Let your winners win and take losses or shave back your losers if the business is eroding. The second takeaway is that you're actually more likely to find good stock ideas looking at the 52-week high list than you are looking at the 52-week low list. Looking at the distribution of stock returns, we know that there's going to be some stocks that lose 75% or more over a 23-year period, and some stocks that are going to gain over 1,500% per 23-year period. So if you had a stock that was on its way to losing most of its value, where do you think that stock is going to show up? It's going to show up on the 52-week low list. And if you had a stock that was on its way to 15 times your initial investment, where do you think it's going to end up? On the 52-week high list. Now, that's not to say that some stocks that could be on the 52-week low list are temporarily battered and they may come back, but most likely a dynamic company and a dynamic stock is going to be on the high list more often than on the low list. So, am I saying you should never sell a stock ever again? Well, not necessarily. Obviously, you have to do your own research, come to your own conclusions, but there are 3 main reasons why you would want to take profits in a stock and move it to something else. None of them have to do with whether the stock price is up or down. Just because it's down doesn't make it cheap, and just because it's up doesn't make it expensive. But there are a couple reasons why you still would want to take a profit. The first reason is that the business is losing its long-term competitive advantage. So something like an IBM comes to mind, where it's just not as relevant in the future economy as it has been in the past. So what was once a wide economic moat is now quite narrow or non-existent. The second reason is that the stock is egregiously overpriced. And I say egregiously here because I think people take valuation a little too far, they get a little too precise. Is the stock just obnoxiously overvalued where there's no way that the actual business results in the future could support today's stock price? And if the answer is yes, then maybe it's worth taking profits and moving to something else. But if it's fairly priced and you still think it's a great business, there probably isn't a huge need to take a profit in something like that. The third reason why you might want to take a profit is if you have a far better opportunity elsewhere. If one stock you own is up big and you think the future prospects are for 5 or 6% per year, and you see another opportunity that you think you can make 12 to 14% per year on, then by all means it makes sense to take it from the 5 or 6% opportunity and transition that to the 10 to 12% opportunity. But don't just take profits in stocks because they are up. Remember that the distribution of returns is asymmetric. So the majority of your portfolio is going to do poor to average at best, and a very small minority of stocks that you own are going to be responsible for the majority of your future gains. So just be careful when cutting those back just for the sake of taking a profit.